Welcome to Season 4 of the Knack for Business podcast.
Today's show is brought to you by Sterling Grace Technologies, and full disclosure, they handle IT for Knack for Business too. Cybersecurity, network support, custom software, cloud backups, all built for small businesses that don't have an internal tech team. Good people, practical solutions. Link is in the show notes.
A question for the listeners. How do you turn a problem property into a stable money-making asset instead of a financial drain? That's exactly what our guest is here to unpack today. He'll show you how to spot the real issues inside a distressed property, how to take it over with confidence, and how to turn those problems into opportunities for long-term predictable cash flow. If you're ready to invest smarter and avoid the traps that sink most first-time buyers, listen closely. He's about to walk you through the playbook. And that guest is Fred Crouch from Gentry Real Estate Services. He is a familiar and always welcome voice here at Knack for Business. Fred runs Gentry Real Estate Services and hosts the Property Wizard podcast. But around here, he's known as the guy who can look at a property and instantly spot what's working, what's not, and where the smart money really is. With over 35 years in commercial real estate and property management, he's helped everybody from first-time investors to major institutions turn messy buildings and maybe deals into stable, stress-free assets. Fred has a stack of credentials for sure, but what people love most is how he makes complicated real estate decisions feel simple and doable. Through Gentry Learning and his podcast, he teaches investors how to avoid the traps, read the signals, and choose the deals that hold steady over time. And when he's not doing that, he's out in the community giving back. And nearly 102 blood donations and counting. If you're looking to build real estate confidence or just want someone who tells it straight, Fred's the guy you want guiding you. Fred, welcome back again, sir. Absolute pleasure. Do you have a favorite quote or saying you'd like to share?
Oh, there's so many. But the one that's very, very applicable to this particular topic is, if there are no problems, there are no opportunities.
So tell me about setting that price of curb value and ugly houses and houses that have great bones but have been vacuumed in a year. Tell me how to turn a distressed property into a showpiece.
Wow. That's a tall ask during just a single podcast episode. But there are a lot of different factors. Let's talk about finding that distressed property first and foremost. As some of your listeners, as I know you both are well aware, I do not just private recoveries. I also do institutional, like bank recoveries for receivers and trustees. And every once in a while, I'll do it for a private lender or a private individual. Oh, the question becomes, how do you spot it? Well, first and foremost, by the time I'm called into any one of those scenarios, what's happened is that someone has defaulted on a mortgage. That's essentially what the trigger is. Now, you can default on a mortgage in several different ways. It's not just a matter of not making your monthly payment. And no financial institution is going to go after you if you missed a monthly payment. But once you start getting, if you miss 2 or 3, then chances are you're going to get a call or you're going to get notification that your lender's not very happy. But other ways that a mortgage or a property can fall into default would be simply by not paying your municipal taxes. That's very, very important. Now, again, most municipalities, and this holds true no matter where you live. At the end of the day, in most jurisdictions, municipal taxes, as do condo fees, hold precedent over any money or any mortgage that may be registered on the property. And by that, I mean those items, taxes, condominium fees, must be paid before the lender is paid. Now, in a lot of situations, it's not a big deal if you're behind a year, maybe even 2. But I've seen situations where the municipal taxes are behind 10, 11, 12 years, and it can add up very, very quickly, because it's not just the base amount of the taxes. It's also the penalties, the notification fees, the interest payments. So you can take a debt that may have been, for argument's sake, $10,000, and it's not beyond the realms of possibility to have that debt balloon to $15,000 or $16,000, over a 5 or 6 year period. So I bring this up because this is one of the ways that you could identify a distressed property. You probably have seen in most jurisdictions, the onus is on a municipality um, to provide the public with notification when a property has fallen into tax arrears. Why? Because the municipality wants to recover. The municipality is not in the real estate business. They don't want to take over your property. What they want is for you or the property to recover the amount of arrears when it comes to property taxes that's owing. So what you'll see sometimes in local papers is a list of what they usually call something along the lines of tax sale properties. And these are properties that have been identified that have gone way past the point where there's a chance or where the property owner has made arrangements to make up the arrears. So you'll get a list of tax sale properties, and what the municipality is looking for is an amount that will satisfy whatever the tax debt is. Now, these are notices that are placed. If the property address isn't noted, then the legal description will be. And so what I've done with some investors is taken that list, and it's usually done a couple times a year, at least in Eastern Ontario, and I've toured these properties with the possible investor. So by the very fact that the property has got to the point where it's being considered for a tax sale process, that identifies the property as being distressed because obviously there's a financial situation at stake here. So that's one way, in a very public way, of discovering or finding properties that may be distressed. Another situation is you'll see notices that are usually issued by receivers or lenders indicating that a petition is being made or an individual is being sued or a company is being sued because of payment arrears, generally speaking. But again, it could be for any number of things. When you're talking about a piece of real estate that's owned by a corporation, for instance, some of the caveats that the lender may have revolve around the timely production or presentment of financial statements. So if you buy a property through a corporation, don't be surprised if your commitment reads, and a lot of people don't even look at the commitment, that portion of it, but don't be surprised if the commitment reads, you must supply the lender with at least, they don't necessarily have to be audited, but they should have reader's notes or accountant's notes attached to it, financial statements dealing with the viability of the company and its future ability to make the payments as scheduled. So there's another way that an average individual, if you take a look at the legal notices, and most every paper in any jurisdiction will have a section. It's usually close to the obits. So just to give you, it kind of gives you that general feeling, but that's where you can usually find the legal notices. So if you go through that and you see something that looks interesting, or a business, or a notification addressed to an individual, sometimes there's an address, sometimes there's not even real estate involved. So you need to at least be clever enough to identify whether or not that legal notice encompasses an interest in real estate. And it's an interest in real estate. When you have a lease, for instance, you still have an interest in real estate, but we don't need to go down that path. But at the end of the day, two very public and simple ways to search and look for a distressed property: look at the legal notices and look at the tax sale properties. Those are two great ways to start. Now, having said that, you'll hear through your own network about maybe a business or an opportunity or an individual that may be having a certain degree of difficulty. Now, in situations like that, they may very well be open to another individual coming in and saying, look, I hear you're having a bit of a hard time. How'd you like to sell this property? Or what's the situation? How can I help? Which is, I suppose, the best way to approach an individual like that, by offering to help first and foremost. You don't want to approach an individual by saying, I hear you're a lowlife and look, I want to steal this property from you. That's never the way to either approach or deal with a situation like that. You need to be in the best deals, regardless of what you may hear out there. It's not all cutthroat. You need to have a certain degree of empathy for what the person's going through. And when you can communicate and have that discussion with them, chances are they may be open to a solution which will involve you purchasing or buying their interest in real estate. So keep your ears close to the sidewalk, to your neighbors. Listen to your business associates. If you think there may be an opportunity, beautiful. But probably one of the most effective ways to turn around and find a piece of investment property that may be going through a distressed period, or maybe just distressed for any number of reasons, and we haven't even gotten there, because financial is definitely one way to identify distressed properties, but there are others too, is to turn around and get yourself a good real estate agent, somebody who deals with that type of work all the time. It's not an area that a lot of agents, realtors deal with on a day in and out basis, but it is, and it can be a great source for you. It really can be. Now, in the shell and the work that I do, going back to what it was I said earlier, if there are no problems, there are no opportunities. So I always kind of look at a situation like that as almost like a double-edged sword, but I don't mean it in a negative sense. I just mean what you can do is you can help the individual out of the situation they're in if a problem exists, and you can also take advantage of it. And I don't mean advantage in a negative context either. What I'm referencing is you can take advantage from just having a presence and having the discussion with them, because on as much of a predicament that this particular individual or the person that's defaulted may be in, there's someone who's going to be willing and interested in investing in that property. Some of the best real estate investments I've made have been solely because of that. You see a situation, and I don't think there's anything wrong with saying you take advantage of the situation. And what you do is, as a result of that, if you have the expertise and the ability, you rectify the situation. And then at the end of the day, it's either hold the property, hold the interest in property, or sell it. And I've done both. So it just depends on the circumstance, period. So those are three very, very direct ways to discover and look for properties that may be distressed. Now, though a lot of that has to do with the financial aspect, but there are other ways to identify distressed properties. I'm sure the two of you have turned around, walked or driven through a neighborhood, and you've got beautiful landscaping and every home is well painted and well maintained and everything. And then you come across this one property where maybe the grass is knee high. It really looks like it needs to be done. Paint or lack thereof is pretty evident. Now, there's a situation where, for whatever reason, it hasn't been properly maintained. And there could be a reason for that. Maybe the individual, or if it's even occupied, but maybe the individual just doesn't have the financial ability to turn around and make the improvements or keep up with regular maintenance. So there's another way. You can drive through any neighborhood, anywhere. I don't care where you are, any neighborhood, and you can all turn around and point to that property. Well, maybe there's something going on there. Maybe, because there's a pretty evident problem, maybe there's an opportunity. But in a situation like that, what do? You park your car, you walk up to the door and knock on it. And just ask. What's the worst that can happen? They're going to turn around and invite you to get your rear end off their property. Thank them very much for their time, period. If you have a card, leave it. It may wind up in the trash, but you don't know. But you won't know unless you try, right? So that's something that's a really obvious way to turn around and try to find or distinguish one property from the next, or a property that really is truly distressed from another. So deferred maintenance, there's one. Keep your ears to the sidewalk. Talk to your neighbors, talk to your friends. Look for those notices, whether it's a municipal tax notice or whether it's a legal notice. Those 4 right there will get you well on your way.
So you've mentioned looking for tells, and those are the tells. But now you look at, let's say the opportunity now presents itself where you can acquire the property. How do you know that is something that you can flip? So, for example, we've heard of a past experience where there was something in the ground that is an environmental contamination. The lender's going, I don't want to take this on. I don't want to own it. I don't want to wear it. But you came up and you looked at it going, you did a quick site inspection going, I can do this. I can do this effectively. The bank can't do it because, that's not their game. They're in the game of lending money, right? So they don't have an arm that goes out and, does that assessment and go, we can flip it. But you have the skill set to do that. How do you know when you're looking at a situation then that, okay, here's an opportunity. Do I have the resources to manage it and make a gain, whether it's immediate or longer term?
So that's a great question. Thank you very much for it. You bring up a couple of points that are worth elaborating on. So the best thing that you can do is, if you don't have the expertise, engineering or otherwise, because you were referencing very specifically a property that was environmentally contaminated. I've dealt with dozens of them. And usually there's a very unique opportunity when presented with a property that may have a certain degree of environmental contamination, because most lenders will not want to get themselves wrapped up with any type of remediation effort. Most lenders will not even want to go on title or appear to go on title. So there's a fine line. So we're getting into kind of a specific that most of your listeners won't necessarily get involved with, but just as a point of clarification, if a lender would have me or ask me to go inspect a property, which happens quite regularly, because there may be some sort of question about environmental contamination, what they'll do is they'll hire me or my firm to go visit the property and do a very, what kind of boils down to, and we're not environmental engineers, but it's like a phase one environmental inspection where you're looking for obvious telltale signs of any type of, contamination. So we've had situations where I've been sent to a property and on the outside looks wonderful. Fenced compound, major metropolitan center, but the front, streetwise, looks great, beautiful. We get entrance to the property, go around, check the rear of it, and the alarm bells start going off. There were literally in that particular situation hundreds, if not thousands, of empty oil containers, drums overflowing, even the little 1 liter container just sploon all over the place. There was a waste oil tank overfilled, and with obvious evidence that it'd been overfilled, and there was oil leakage all over the place. So in a situation like that, what I did was contact the lender and took pictures, sent them off to the lender. And I said, we're ready to take over this property on your behalf. However, I recommend against it. And this is why. And I sent them the pictures. I sent them everything that was very, very evident. And the bank made a decision right then and there that they were not going to take possession of the property, because as soon as they got into the chain of possession, anyone further down the line, even if the property was, let's say it was remediated, you can never be 100% sure. But down the line, if future contamination was discovered or contamination that wasn't properly cleaned up was discovered, it's as easy for the individual who owns the property then to go back down through the chain of title and discover who's got the most money, who can I go back to with a lawsuit saying you knew about this or you had possession of this property and you didn't rectify it. And 10 times out of 10, they are going to look at the biggest and most financially secure individual or institution. And that is always going to be a bank, always. So the bank does not want to take possession of that property because of the potential of environmental contamination. But it has to be very evident. So I just want to really clarify or elaborate on that point. So getting back, I guess, to the other part to that question was,
well, the question is, you come across something, it's in this case, it was environmental contamination. It could well be, the place wasn't painted in a long time, right? Maybe it needs some drywall on the inside, a little bit of brown refitting, brown building. How do you know let's do that versus that's a lost cause? The only way to make that right is razz the building and turn it into a parking lot.
It's as simple as a cost benefit analysis. You need to go through that property and you need to say, okay, this is what we need to do to make the property rentable, leasable, sellable. That's what you need to do. So it all depends on your market. It all depends on the property itself, its location, all these different factors. So there isn't what I would call necessarily a template that you would use. You need to have a certain or possess a certain amount of expertise. But if you don't possess or have that experience, because as I've often said, experience is the best teacher. If you don't possess that experience, then hire somebody who does. Have them tour the property with you. Have them give you some sort of cost breakdown as to how much money it's going to take to get this property back onto the market. How much money is it going to take to maximize the utility of that property? So if you're not in a position where you can take a look at that property and say, it's going to cost me this, and this, then hire somebody who does. Hire a professional. That can be an engineer, maybe a building contractor that you have experience with. It can be any number of people. If there's an issue outside the physical aspect of it, then go speak to your lawyer. Speak to a lawyer who specializes in real estate law, no matter where you're at, because it sounds pretty easy, but it isn't necessarily as easy what it sounds. If you can kind of catch my drift. What I'm saying is that there are lawyers who are general practitioners, just like a doctor, have wonderful practices, but there are also lawyers who specialize in real estate and real estate law. So it could be maybe there's an issue on title that needs to be rectified. So at the end of the day, you want to attract or you want to have in your stable of professionals on your team, and we've spoken about teams before, an individual that can provide you with an assessment. Look, I'm fairly well versed when it comes to what it's going to cost and what needs to be done to a property in order to maximize its utility. However, even with my experience, I will very often lean on another contractor or an engineer to confirm my initial analysis. So if you don't have the experience, don't fret, find the experience. And you find the experience by bringing and having on your team, your real estate investment team, someone who may have far more or is better educated or has more experience than you might possess doing what it is you think needs to be done. Now, in some situations, it could be a matter of, we're talking about physical instances right now. We've touched briefly on, legal issues, clouds on title, but it could be maybe the property just isn't being marketed well. You could have a beautiful strip plaza with no obvious physical delinquencies. Maybe it's just a marketing. Maybe, they're trying to attract the wrong type of tenant. Maybe the landlord is pretty stubborn and doesn't want, the landlord being the property owner, wants a particular kind of tenancy or an individual there. But when you take over a property like that, you're not bound by what the previous landlord may have perceived or wanted his building to be. That I'm suggesting all contracts when it comes to tenancies must be respected, if they've been entered into by a previous property owner or landlord. So I'm not suggesting that just because you buy a property, you can turn around and tear up the leases. No. You need to work within what the actual lease documents say in the case of a tenancy. But not all properties are tenanted. We could be talking about a single family home. What about that single family home that you see, as we said earlier during this podcast? You're driving down the street and you say, boy, that place really needs a facelift. You'd be surprised what you can discover. I've done it, and I've always managed to kind of make the individual my friend or at least, offer to help them. So, I don't think I've ever been physically thrown off a property yet. Although there's still plenty of time, it may happen yet. But at the end of the day, there's all sorts of different, indications, and there's all sorts of different ways on approaching a situation or a problem as it may exist. So, but each property and each situation is unique. And there's always a story, If you're dealing with a property owner directly and you've offered to help or you've made an offer to buy their property, You can sit down and listen to some of the stories these individuals have, because there's always a story. There's always a reason why. There's always a story, and you can learn from that individual's experience. So you know what? That's why, as I've often said, that's why you have two ears and one mouth. So you listen twice as hard as you speak.
Fred, you've been at this a while. And one thing I respect about you is you don't get victim easily of this week's flavor. And one thing that bothers me in real estate is, I would say, after the pandemic, maybe 3 years ago, people confused realty and casinos. And so people started picking numbers, valuations out of complete random. And your $400,000 house is now a $900,000 house, and nothing changed. And then maybe it wasn't a $900,000 house, so it's now only a $700,000 house. One thing that I learned or thought I knew a long, long time ago was principal, interest, and taxes. Can I rent this property for Pitt and be fairly even and have my principal, interest, and taxes? And this $700,000 home is not going to rent for enough to cover your principal, interest, and taxes. When did we throw that baby out of the bathwater, and how does it come back?
Well, it's pretty simple. Just stick to your guns. I'm not trying to, I never advise an individual to buy based on future, what you think it, let me rephrase that. What you have to do is you have to deal with the reality. Okay. If someone is asking $700,000 for a property, but yet fully rented, and there's no other way to either supplement or increase your net operating income, is what it is. You can't see yourself getting another $500 or $1,000 a month in income from this property, and somebody wants $700,000, and it's not going to carry itself with a reasonable down payment, then walk away. Walk away. That may sound difficult, but that's at the bottom. At the end of the day, if the deal doesn't fit your model, walk away, period. That's how you're going to get back to more realistic or a stabilized type of market. But again, I mean, that's the first bit of advice I would give. But some markets, Wayne, are worse than others. You know, there are pockets, for instance, where in Eastern Ontario, we're very, very fortunate, very, very stable market. Another market in Ontario that's quite good is the Kingston area. And another one yet is London, Ontario. Can either of you tell me why you think those three regions, probably have such a stable real estate market?
I guess we have a lot of people who get paid by the government and their money's safe.
Well, that's true, not just here in Eastern Ontario and Ottawa, but for instance, even in the Kingston area. You've got a number of penitentiaries, well-paying jobs, federal in nature. Again, very, very stable. London, Ontario was much more attractive before than what it is today for other reasons. But you've got a number of universities, and it was it still is. Certain aspects are still very, very attractive about London, Ontario. And I have a bit of a soft spot because that's the hometown that my father grew up in so many years ago. So I have a memory of London, Ontario that goes back 50 years. So it's not the same today. I'm not suggesting it is, but these are very, very stable markets. And you're going to have far less in the way of discrepancies in those type markets than you are in other markets that are so volatile. Look at what's happening to my friends in Toronto right now. The condo market has plummeted 25%. There are condo towers that they've sold units, but they're not going ahead with construction. Why is that? Because the cost to construct exceeds what it is they're going to realize at the end of the day. So most of these, and the problem with major condominium towers is the fact that they are years in the planning process, years. So many of these developments that may already have shovels in the ground, you could have a pit right now where the underground garage is going, has stopped. They've stopped dead in their tracks because these are projects that were approved pre-COVID, and they were based on financial aspects, costs that were pre-COVID. Now look at what's happened since then. Costs have skyrocketed. Now, they did come down somewhat, but not anywhere near what they were back in 2021. I mean, just nowhere near. So your question is I thank you for your question. However, there's a lot of caveats. I mean, it really depends. You can't control. There are large market factors that come into play that we don't have any control over. One of them is being the cost of money. Now, are we going to see the cost for a 5-year mortgage plummet much more than what it is right now? I'm not so sure. I don't think we're going to see them at the same rate that they were maybe 3 years ago. Not right now anyways, but if the cost of money increases, the less your investment dollar is going to buy. So that's one of the things about real estate. I mean, can you turn around if it's going to cost you? Like, I'm thinking back, we're all old enough to remember 1980s, early mid 1980s, when a first mortgage was going to cost you 14, 15, in some cases 16%. I'm sure some of your listeners right now are listening to that saying, what? 14, 15, 16%. Yes, that's what a first mortgage was going to cost you. That's exactly what it was. If you were planning on buying a property, that's the reality of it. So, but that's something that we couldn't control. As an investor, I bought any number of properties, but I always bought them with the knowledge that this is what the interest rate is. This is what this property is worth, because this is what it's going to cost me to carry. So what happens is that when money is cheap, everybody feels like they've got a pocket full of cash and they want to go out and invest it in real estate. That's what they want to do. And not just in real estate, but other things. But this is a real estate topic. So when money is cheap, everybody's buying. What happens when there's a lot of pressure on the market? What happens in a supply and demand economy? What happens? You're absolutely right. It skyrockets. So all of a sudden you've got cheap money. You've got people that maybe have been saving. They want to buy. I'm not just talking about investment real estate. I'm just talking about a single family home. So what happens when, demand outstrips supply? Prices go up. And that's exactly what we saw. There's no other factor was involved. Prices started to skyrocket. That's what they did. So what you're seeing now is that in some markets, like the Toronto condo market, and look, Vancouver's not far behind. In fact, depending on what report you read, it's kind of tough to call out either Vancouver or Toronto right now as being the front runner when it comes to either defaults or projects that, are not going ahead. That's all that happened there. Interest rates were kept low to stimulate and help people through the pandemic. But at the same time, people looked at it as an opportunity to get into a house. Maybe they thought they'd never be able to afford one. Then all of a sudden, interest came down to the point where we can't afford not to own one. That puts additional pressure on the market. And voila, you have skyrocketing prices. So that goes back to your initial question, Wayne, or your observation about how can you see these wild swings in the value of a property. Well, at the end of the day, a property, no matter what property it is only worth what another individual is willing to pay for it, period. So you wouldn't see these wild swings if there wasn't somebody there waiting to buy it. You wouldn't see it. So keep that in mind. It's not anybody's fault. It's just in that particular situation, when you're talking about interest rates, that's really a matter that we don't, as consumers, as real estate owners and investors, don't have a great deal of say. Now, another factor, just to kind of finish that topic up when it comes to the volatility of home prices, another factor which you have to keep in mind is that for a good 4-year stint, the liberal immigration policy, and again, this is a non-political show and it's a non-political observation, but the harsh reality is that when you have, a prescribed 500,000 additional persons coming into this country, and some would suggest when you start turning around and adding students and those on temporary visas, that figure was closer to 1 million or 1.1 million. Where are they going to stay? Canadian housing industry just released its starts for this year. I think the year ending October. We only made 1,000 new housing units. That's it. So that's in the previous year, 239,000. Now in their heyday, that figure was closer to 275, 276. I think we may have even had a year where it was 310, 315. But when you've got a million additional persons calling Canada home, where are they going to stay? Explain to me where the thinking was in that logic. Maybe you don't want to, because that's going to take us down another path.
It's a different podcast. Good
Completely.
topic, different podcast.
Exactly. So at the end of the day, there are a lot of factors that affect what you and I, as homeowners and property investors, are going to pay for a property. But just because somebody says, well, my place is worth 700 or 800,000, or somebody is asking what you and I may think is an outrageous amount for the property, doesn't mean they're going to get it. Look, you can ask $10 million for your property. That doesn't mean your property is worth $10 million. Remember what I said earlier. A property is worth only as much as what the next person is willing to pay for it.
Thank you, Fred.
So, Fred, to get back on track with the distressed properties, have you ever come across a property that had an intended use of X? Whether it was shopping, retail, etc., and then you said, you know what, based on location, setup, it can also function this way. And is that how you establish the rapport? Because housing, like residential housing, ebbs and flows, right? Like you talk about a duplex, triplex, etc. But some of this stuff's also from a commercial end, because we know of another place that you're engaged with, right? And you're looking at it, and we've both gone through the establishment, and I'm going, wow, this is fantastic. And then I'm sitting there going, to refit this to code for fire code alone, it's going to be a large chunk of cash. Is there opportunity? And location-wise, it's extremely ideal. Without actually mentioning the location, because it's not up for the conversation. But what I'm getting at is, you can almost feel there's other potential in there. How do you figure out? Yeah, that's going to work. Are you spitballing, or is it?
So there are some tremendous programs right now that CMHC offers through their ML1 program that actually what it does provides, and this is right across the board, right across Canada, it provides financing, preferred rates, longer term amortization periods based on a point system. There's a lot of push to take properties just like you've described, maybe a property that is more industrial in nature. Maybe it was a warehouse. Maybe it was actually a manufacturing facility. Maybe it was some sort of, maybe it was a cannabis related property. Now, a lot of money was put into a lot of these type of buildings. So you kind of stand back and you take a look at them and you wonder, okay, all right, well, maybe the market's fallen out, for this particular use. Maybe it's just become functionally obsolete or inefficient due to power requirements. Maybe, a manufacturer moved down south or moved into a municipality that offered them certain incentives. Right now, there's a huge push for data centers. The number one requirement for data centers is power. So a lot of these older industrial type buildings can be used or repurposed for a data center, for instance. But there's a certain amount of infrastructure that still needs to be allotted for. But one of the most interesting buildings are those that were at one point in time used for an industrial purpose or some sort of manufacturing purpose that are now being converted to residential uses. Really exciting. Each project is unique on its own. Some buildings don't lend themselves well to that, but others are just naturals for it. So a lot of conversion from industrial space, a lot of conversion from office space, but I think we've beaten that horse long enough. Not every office building is suitable for conversion to residential. And that has more to do with the center hole type plan or the way the utility is built into an office structure. As we all know, usually there's a center core with an elevator service and otherwise. And usually all the ventilation services are shunted up this center, the center shaft, and then they go out from there. That doesn't lend itself very nicely to a residential use. So you're best when you're taking a look at a conversion to discount all that and consider that the shell is up and you have to build out from the shell because the utility or how useful a lot of these commercial aspects that you see in an office structure or building, for instance, are going to be, or how useful they're going to be to a residential conversion, can be really questionable and very expensive. In a lot of instances, just the cost to convert will cost more than if you tore the whole structure down and rebuilt from there. Very, very expensive. And there was a time, and what we're talking about here are really what we call class C type office buildings, where a lot of these windows don't even open. So all the windows have to be replaced too. Not all of them, but the vast majority of them, because I don't know about you. You like to be able to open a window every now and again, right? So, it really, really depends. It's an exciting aspect of any type of real estate redevelopment project, Bernie, and I thank you very much for bringing in, but more so than any other type of investment property, the building needs to lend itself to that purpose or use. So the good part about all that is that chances are, if the functional utility of the building is obsolete, we call that obsolescence, for instance, then it's prime for a reconversion, prime for that. And that's one aspect and one investment opportunity, but that's not necessarily for a mom and pop investor. I mean, if you want to turn around and take a look at maybe a small corner store or something along those lines, and you want to reconvert it or reconfigure it, or maybe even make it a residential unit, great. But these major projects are usually taken over, and we're talking about converting an office building into residential. These major projects are usually taken over by investment trusts and funds and REITs, real estate investment trusts, because you have to have deep pockets and you're dealing long term. As a matter of fact, it may cost you more at first to convert the property than maybe what the property is worth, but a long-term play would suggest that, the flavor is never going to rid us of residential accommodation. There's more pressure on the residential market. And because there's more opportunity for investors like you and I to go in and convert existing structures or add units. But that's a topic for another podcast.
So let's assume that this resonated. And let's say, I don't know enough about investing in real estate. I wish there was a course I could take. Any thoughts about where I might find one?
That's a loaded question. Again, you with the loaded questions. Yes, of course. Please visit our website, gentrylearning.com. And there you'll find we've got a number of different courses that are geared towards those who have an interest and curiosity about investing in real estate. It goes through the most basic of concepts, but it's a great, great start if you know very little about investing in real estate. And of course, you can always send me an email. I'm happy to, and I've received several from your listeners, my own listeners. Always nice to hear from somebody. Happy to help if I can. Send them on their right way. But yeah, if you visit the Gentry Learning webpage, I think that's a great start for any investment journey. Thank you for bringing that up, Wayne. Much appreciated.
And if I want to buy or sell a strip mall, the email I should use is what?
You should get a hold of me, Fred, F-R-E-D, at gentryres.com. Gentry, GENTRYRES, that's short form for real estate services.com. Fred at gentryres.com.
Thank you so much, Fred, for being a guest again and giving great insights to real estate and investing in that space. My co-host, Wayne Pratt, and you, the Knack for Business listeners. So if you learned nothing else from today, Fred offers a course. He's a podcaster. His podcast is The Property Wizard, which is available on all of the major platforms. He stepped into buildings that people have written off and turned them around into thriving, well-run spaces, whether they support families, businesses, or whole communities. His mission is to give everyday investors the tools to see past the stress, spot real opportunity, and build a future on steady, dependable terms. And one of his favorite memories is helping a new investor rescue a failing property, watching their fear turn into pride when the building finally started performing. And that's what you're looking for.
Everything you heard today is for educational purposes only. It's not professional advice. Before you act on anything, talk to a certified expert in your area. Your accountant, your lawyer, someone who knows your situation. We share perspectives. You make the decisions. Want more? Head over to blog.knack4business.com, packed with practical episodes on AI, marketing, leadership, and growth. No fluff, just the good stuff. Subscribe while you're there. Until next time, keep building.